Okay, good evening, everybody. Or good afternoon, I suppose. So I just noticed that I was busy setting up and my cat is actually still here. Usually I lock her out, but we'll see if she's good today. See if we can get her back in the shot. Hopefully she behaves. Usually she's walking all over the keyboard, so we'll see. Maybe midstream I'll just shove her out the door, but for now we're going to go with it, so... thank you everybody for joining me. I'm a little bit in a rush here. Sorry to be late. Here we go. Yeah. Go look at the camera, check out the microphone. Yeah. Things look different today, so she's going to have to check everything out. Okay, so let's just try to ignore her. And what I wanted to talk about today, and this comes up literally every time the VIX index spikes like it has. So it's up over 30 these days. And every single time this happens, people, over social media, my email blows up all the time. People are confused as to why volatility starts to drop while the S&P 500 is still showing weakness. So the S&P 500 in the last 3 or 4 days, it's had some down days and it's had a little bit of scary action. But the VIX index itself has been down for 3 or 4 days straight. The UVXY, the VXX, they've been down. Everything is kind of dropping down. So it seems to surprise everybody, and then you hear a whole bunch of comments about VIX manipulation and the big, bad, shady bankers out there are trying to rug pull everybody. So, it's about time we do a full live stream, start to finish, kind of explaining why this is very normal and very expected. So I'm going to go into, I was going to do 2 topics, but I don't know how long we're going to go, so we'll just do 1, and then the rest will be the open Q&A. So I am going to do something, bear with me 1 second here. I've never actually done this before. To surprise it. But I'm just going to link, just in case anybody's curious as to our actual live trades, I'm going to link something in the chat. And I've never done this before, but let's see if it works. There is a free trial for anybody who wants to sign up. This is a time where we are kind of bouncing around between long volatility, gold, real estate, kind of our safety positions. So if you want to, what is that? What happened there? Hopefully you guys didn't see that. Some window popped up. But yeah, if you want to see kind of the timing of our signals and all that, you can go ahead and sign up. There's a 2-week free trial. You can see all the trades as we go, see the daily blog, and yeah, you'll get a little bit of a backstory as to how we trade the basically stocks, bonds, gold, real estate, all the normal equities, normal assets using volatility indicators. So feel free to do that. But let me do a quick intro and then we will get right into it because this is a pretty important topic and I think people are going to be interested as to why I'm expecting volatility to go down even further than it has already. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff, I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. Okay, so let's get right into the topic here because what I notice, and I've been trading through all of these market crashes all along the way. We've seen the VIX go to 30 several times. This isn't the first time. But what tends to happen is a lot of people start going long volatility sort of right at the heart of the crisis. And this isn't necessarily a bad thing. I do it as well. But there's a lot of people who like to go long UVXY, long VXX, the old TVIX. Remember, that was a big popular one. And then they're always surprised when the trade doesn't work out, when volatility depresses, especially because this week there was a couple of days where the stock market was down. And of course, I'm on Twitter and I see the comments, and just people are just repeatedly surprised that they bought UVXY. Of course, they want the stock market to go down so that they can make their profit. Stocks do go down, and then volatility goes down with it and they lose money. And of course, people do think they're a little bit ripped off and maybe there's some manipulation going on. So the first thing that I want to cover really quickly, and it has to do with a video, my most recent video. Hold on a second. Sorry about that. There is something going on with my software. So sorry about that. Bear with me. There seems to be a screen popping up here. Can I just shove that to the side? God, I don't want to. Okay, hold on a second. I'm going to make that. Oh, sorry about this, everyone. Is this good content? Just watching me fumble around here, technical difficulties. I'm just going to put that to the side, and I'm going to assume that you guys can't see that little secondary window that keeps popping up. So what I did recently, the most recent video, if you go on the YouTube channel, I did a full description on beta. This is part 7 of the Volatility Lingo series, and I went through what beta actually is. But first of all, let's just settle why people right now think that if the stock market goes down, that the volatility ETPs they are buying or the VIX options that they are buying, why they expect those to actually go up. So let me check if I'm doing a screen share. All right, I think we're good here. I don't know, my software, every time it's different, but here we go. So we'll just quickly go through what beta is and why people think there's that inverse relationship. So beta is a measure of volatility of one security in relation to another security. So it's a really good way to get an understanding of what you're holding and how that's going to behave compared to the S&P 500. So the first thing that beta measures, it's a really useful indicator because it measures two things that are important for us. The first is, of course, direction. So positive beta values mean the two securities move in the same direction. So anytime you would have a positive beta, here we're doing utilities to the S&P 500, but pretty much most of the stock market is also going to have positive beta, your Apple, Tesla, at various levels. Anything that is generally positively correlated to the stock market will have a positive beta number. And then negative beta means that the two securities tend to move in the opposite direction. I should have highlighted tend to move. It's more of a long-term indicator, but they move in the opposite direction. So treasuries, there actually isn't a whole lot of assets out there that do move with a negative beta, which makes tactical investing a little bit difficult because, of course, we would like to have some safety positions, but they're actually pretty hard to find these days. We'll see how long the treasuries, the bonds hold up as a negative beta asset class with interest rates being set to go up. We don't really know how things are going to react, but that's what negative beta means, is that there's actually an inverse directional relationship. And then it also measures magnitude. And again, this is important as well because not everything moves in tandem with the stock market. Some things will be weaker, and then some things will be substantially stronger. So positive beta means that it has higher volatility. You should expect it to move around more. So Tesla, for example, at positive 2.05, not only is it positive, so it's same direction, but it's also larger than 1, substantially larger than 1. So Tesla will move more, right? And because it's positively correlated, if the S&P goes up 1%, we would expect Tesla to go up more than 1%, probably 2%, maybe more than that. Negative beta values, beta values less than 1, means it has a lower volatility. So these are your Coca-Cola, Johnson & Johnson, more stable stocks. Certain, I think the utilities ETF was 0.65. It means it's positively correlated, but it's moving slower. It has lower volatility. So what I want to calculate is why people think that buying UVXY is a good play, for example, when there's issues with Russia and Ukraine and all the nightmare over there, the war and whatnot, or maybe I shouldn't call it a war. I was watching something today. Gary Kasparov, the chess grandmaster from Russia, I just was listening to a podcast with him speaking, and he mentioned something about if you even mention the word war, in social media or in protest, it can, land people in jail. You can get into serious trouble. So I guess we're supposed to say it's a special operation. But whatever it is, there's a reason people are buying the UVXY this week. And unfortunately, a lot of them have been very disappointed. So the beta of the UVXY to the S&P 500 is actually minus 3.76. So remember, the negative number means that it's inversely correlated. So we will expect if stocks go up, the UVXY goes down. That's the short vol trade. If stocks go down, we would expect UVXY to go up. The very large number, much larger than 1, means that the volatility is extreme, 3.76 times the S&P 500 on a long-term basis. So not only is it expecting to go inverse direction, but substantially. So if the stock market drops 1%, Tuesday it dropped significantly, Thursday it was down about 0.5%, people are expecting their UVXY to really pay off. And not only did it not pay off, but it actually dropped almost 7% itself. Now, probably since I have this open, I should probably just show people how to do this. It's very, very easy. If you have the data for UVXY and you have your SPX data, then all beta really is the slope of a line that passes through a regression of data points. So our data points are here and here, the daily returns of UVXY compared to the S&P 500, and we're just getting the slope of a line. So we can just do slope, and then I've actually already prepared it. 45.15 sell is update today, so I'm just going to drag this down, do 45.15. That puts it down to the current date, and then we're going to compare that to the SPX over the same time frame. Okay, so there's our beta. That's literally how easy it is to calculate beta. So minus 3.76. Now, one thing you might be curious about, and this kind of speaks to the fact that for a while there, about 2012 to 2017, we call that the golden years of the short vol trade. And then things kind of went haywire recently. You can see that the rolling 10-year beta for the UVXY to the SPX is actually 4.72, minus 4.72. So it's even stronger than the long-term 17-year beta starting in 2004. Those were weaker times for the UVXY. And then after the financial crisis, of course, things accelerated. Beta started to go down, started to get larger, and then things went really crazy around Volpocalypse, of course, COVID. I think I can say COVID on YouTube these days. If not, I guess just got demonetized, but it is what it is. So currently, the rolling 10-year is minus 4.72. So a lot of people out there disappointed this week that the UVXY is down about 20% or something, and stocks are still weak. Next, just to go a little more thorough, this is the VIX index. So same thing, we can calculate the beta of the VIX index in comparison to the S&P 500 as well. And again, negative 4.53. This means, and it's the same calculation by the way, you just basically just do the slope of the VIX percent change to the SPX percent change. You can do point change if you want as well, but negative 4.53. A negative number means it's an inverse correlation, and a very large number means that it moves substantially more than the S&P 500. So if stocks go up 1%, the VIX is probably going to go down about 5%, somewhere in there, 4 to 6%. These are long-term averages, but same thing. And if we look at the rolling 10-year, we do see the same action, where the rolling 10-year VIX to SPX is actually minus 5.47. So significantly inversely correlated to the S&P 500, which is why there's a lot of people disappointed in screaming manipulation this week when, I think I can even show that. There's that message again. Sorry, it's really throwing me off here. Not that I'm ever really on my game, but it's throwing me off my live stream game. I keep getting this pop-up. So hopefully everybody's with me still. I see a few comments, see a few thumbs up. So I think there's a few people here. But yeah, basically, we have actually seen the S&P 500 drop Tuesday. It dropped Thursday. And starting on Monday, it's been weak the whole time. There was one big up day, but if we look at UVXY, for example, it actually has gone down pretty consistently, pretty substantially since Monday. This is Monday here, and it's just been straight down frustration for people who are holding this on the long side. So, I mean, I get it. There is a strong inverse correlation there, but we have to understand that, sorry, my cat is trying to kick my hand away from my computer. You have to understand that those relationships are more long-term relationships. And when volatility gets this high, this elevated, which does happen from time to time, I mean, the VIX was touching 30s last year as well, you have to understand that at some point it's going to have to fade, because the best way to think about it is that when volatility is elevated, the S&P 500 has a strong burden of proof to prove to the volatility market that it's justified for volatility to be this high. If it's not continuously proving it day in and day out, then volatility would have to drop, right? If volatility is pricing in massive movements in the stock market and it's just not quite happening, I mean, the fear is there. I feel it as well. Every day I log in, I think it's going to be limit down today for sure. Something terrible happened in Ukraine and it's going to be limit down. But it just isn't. Every day we it's not been good, but nothing has really broken yet. I mean, what's the worst daily movement? It hasn't really even been that bad. So the S&P 500, equities markets, always have that extended burden of proof through one of these cycles. And the longer it goes without actually justifying the high vol, you're going to start to have that correlation break down. Those strong -4 beta factor, -5 for the VIX, they're going to start breaking down, and you should expect volatility to decline. So I'm going to show that. There's that stupid message again. We can actually show that with both of them. So we'll start with the VIX index, and this is sort of going far beyond. There's a lot of people who don't know what the VIX even is, so this will kind of explain that as well while I'm explaining, why volatility is being faded here. But the VIX index, it's very, very simple. It basically represents the market's expectation for forward 1-year movement. And something that confuses a lot of people is you often hear the VIX being talked about. It's a forward 1-month volatility. That is true. It is. It's based on S&P 500 options, and they do use a strip of 30-day out of the money, in the money, a full strip of those options to calculate the VIX value. But then it is an annualized number. So that's the part that actually confuses people. Because when you see the VIX value, let's say the VIX is 30 today. I think it's 29 or something, but 30. This isn't $30. It's actually 30%. And what it means, very simply, is that the market is predicting that the S&P 500 will move 30% in the next year. And it's plus or minus. A lot of people think that that inverse correlation has to hold. It's also plus, right? It's just volatility. It doesn't specifically say it has to be down, right? So that's what a 30 VIX means. It just means that the market is expecting a 30% move. So when you see that value of the VIX, it is a percentage. It is just the market's one standard deviation expectation, and that is all based on S&P 500 options market. So because it's an annualized number, it's actually really easy to calculate different time frames. So if you wanted to know how much the market is pricing that 1-month time frame, remember the VIX is 30-day option strip, but it's an annualized number. All you have to do is divide by the square root of 12, because there's 12 months in a year, which the square root of 12 is 3.46. And the 30 VIX is implying an S&P 500 move of plus or minus 8.67% over the next 1 month. Now, if you want to see why volatility is declining, this is why. I've marked right there where this is the rolling 1-month performance of the S&P 500. This is going back to 1990. And right there with that red line is 8.67. That's the number we just calculated there. A 30 VIX is implying that the S&P 500 is going to be moving this much on a monthly basis. You can see how rare that actually happens. So there's a big burden of proof right now with the VIX to stay at 30. The S&P 500 better start moving quick, and it better start moving a lot day to day. A whole lot more than it has been. We'll get into that, as we go further down here. But we can also do it weekly. So there's 52 weeks in a year. You can take that 30 VIX, divide by the square root of 52, which is 7.21, and you get an implied move of 4.16%, plus or minus. Don't ever forget that. It might be plus, over the next 1 week. So how often does that happen? Well, that happens here. It's actually quite rare. Again, the S&P 500 doesn't actually move on a weekly basis more than 4.16% very often. Obviously, during crisis, you can see that the highest move, it's spiked upwards in November 2008, very high for 1 week, and down 18% in another week in October in 2008. But again, in order for the volatility to be justified at these really high levels, the S&P better start moving pretty quick. And I think this is the one that's probably most useful for people, is the daily. So there's 252 trading days in the year. The VIX is a calendar calculation, but there's 252 trading days. You just simply divide the VIX index, the 30 that we are assuming it is today, divide by the square root of 252, which is 15.87, and we have an implied daily move of plus or minus 1.89%, basically 2% per day. And the S&P 500 is not moving 2% per day. It's not moving even close to that. It feels like it should be, and there's definitely crisis in the air. I mean, like I said, I'm expecting something terrible every morning, or one of those limit up days. You know, if you get one of these great news headlines where it seems like they've resolved the conflict and everybody's, excited about the future, you might get a 4 or 5 up day, and that would count as volatility. Remember, plus or minus. But we've just not seen it. So, of course, volatility has to go down. It's not justified at these levels. So if you want a quick little cheat sheet, you can come back to this live stream in the future, but this is basically, come on, cat, zip it, I'm on a live stream. She's very rude. So you can see the VIX values here, and you can input your own. I've basically showed you how to do this yourself. But this is what the VIX is implying for a 1 month move. Remember, divide by the square root of 12. 1 week, divide by the square root of 52. And 1 day, divide by 252, representing trading days only. This is it. You can just basically calculate how much the VIX index is implying the S&P should be moving. And if it's not moving this much, you can bet that that correlation is going to break down. There's no reason why the VIX index should stay at 30 if the S&P is not moving 1.89 sort of on average a day. So up or down 1%, up or down 3 the next day, 2 the next day. We're just not seeing that. It did feel like we were for a while there, but it's been stable. And the longer this goes, I mean, the S&P is down 0.4% today. That's not enough. We're going to have, the VIX is going to have to go down if all the S&P can muster is down 0.4%. So that's essentially what's happening. That is why basically a lot of broken dreams this week when people are kind of waiting on the sidelines for that time to strike the UVXY or get those VIX calls and have it go back to 80. It's not going to go to 80 unless it's actually justified to go to 80. So as far as the UVXY goes, remember the VIX index. This often confuses people as well. Believe me, my email inbox is full every day for this question. Why did the VIX do this and the VXX did that and the VIX went up but the UVXY went down? It's because they're entirely different products. So the VIX index is priced based off the S&P 500 options market. The UVXY is priced entirely off of the VIX futures. I might have to lock the door in the future, but she's acting cute over here. The UVXY, the VXX, SVXY, all of the volatility ETPs, they're pricing directly off the VIX futures. So this is completely separate. It can decouple completely from the VIX index. Remember, the beta factor was quite similar, minus 3.67, I think, compared to the VIX of minus 4.5. It was fairly close there, but they're getting their pricing on different things. But one thing you can do on the VIX or on the VIX Central here, this is VIXCentral.com, everybody's favorite website. Go to the historical tab, get the date that you want to start at. So I'm sure most of you know how to do this, but for the few that don't, March 7th, Monday of this week, and just get the prices. You can see that these are the VIX futures. So the UVXY is being priced based on these front two futures. And you can see there's 8 days to expiration. So the actual 30-day constant maturity future that these are based on the number of days to expiration, which is only 8 now, it's probably somewhere, in between this threshold. So let's say 33 something. That's the VX30 number. Whatever that number does is basically how the UVXY is going to be priced. So it doesn't matter what the S&P 500 is doing. What matters is the VIX futures are a freely traded market, and they can do whatever they're going to do, whatever traders are pricing in at the moment. And a 33 VIX future for the VX30 is a lot. So go to the multiple dates tab right there and go to the next day and add that one in. You can see it dropped. So it didn't matter that the S&P 500 went down. That doesn't matter. It still didn't go down far enough to justify these VIX futures traders to think that this volatility is justified. So it has to come down. A VX30 of 33 is too high right now for a market that's only moving 1% a day, not 2% a day. Go to the next one. Dropped again. Now, this was a day that the S&P 500 was up, so this isn't overly surprising. But you can see UVXY should be going down substantially. These are fairly big moves. Add another day. So this is the whole week, basically. Dropped again. So there's no reason to expect that the UVXY would have had any good days in this period. It doesn't matter that the S&P had 2 pretty ugly days. The UVXY didn't, because the VIX futures have just dropped every single day. So where is it now? Front month 30.42, and right now today 29.52. So it dropped again. So again, we should look at the UVXY, and it's down 3.3% again today. This is expected because, like I said, like we've been talking about, the burden of proof is always on the stock market to justify what all of these traders are doing with their hedging, right? That's what's essentially happening. Everybody's scrambling around trying to figure out how to position their portfolio, and there's a lot of fear and there's some uncertainty, and we're doing the Fed raising rates next week. Is it going to be 0.5? Is it going to be just 0.25? I suspect 0.25, but who knows? They might surprise us. There is a lot of things to be worried about right now in this market. And it's just a terrible economy on top of that. That's the other section I was going to do this week. I was going to talk about, I just hate seeing people online talk about how the economy is strong. It's so far from strong. It's, it's kind of laughable, but we'll push that one to next week. So tune in next week and we'll talk about the so-called strong economy and why I say that's just absurd. But a lot to be worried about right now. But the S&P 500 actually does have to move day to day, roughly 2% a day to justify a 30 VIX. And those VIX futures priced at 33 for the front month, the S&P is going to have to do something crazy. Otherwise, boom, it's going to go back down. Doesn't matter if the S&P is flat for a week. Let's say all of next week it's just up and down 0.5, minus 0.5, and the S&P is still in a 10% drawdown next week, and it's still scary and people are still nervous and nothing was resolved. That doesn't matter. How we feel does not justify a 30 VIX. 30 VIX is very high. It needs to come down. So one of two things has to happen. It's just the law of volatility. Either the stock market has to start moving or volatility has to drop down. I'm not predicting one way or another, but you need to price your trades knowing that one of those two things has to happen. If you're of the opinion that the S&P will suddenly start kicking in and going, maybe your long vol positions will work out. But actually, I can probably even go one step further here and show how this affected our community as well, because, come on, Internet, what is going on? My volatility barometer as well, because it's a comprehensive view. It does include the VIX futures, but it's much more than the VIX futures as well. But we can go on the 8th, 9th, 10th. You can see that what happened in my volatility barometer was kind of the same thing. 82.41. The higher the number, the more volatility there is in the market. So, of course, we are touching extremes here. And because of that, you can see that we are in our sort of extreme type positions. We're in cash in this strategy, full on cash, safety. We're in gold here. This has been rocking for us recently because gold's doing tremendously well the last month. And we're in long volatility, just a little sliver there, but we were in long volatility, and it did quite well for us as well. And then our VXX butterflies are in cash. So because it's so high, I was also in full safety and long vol. But midweek, we had to move out because despite the fact that the S&P went actually down, should have justified those positions even more, the volatility barometer dropped. It actually dropped 3%. So we had to exit the long vol position, even though the stock market was going down. And then again, you'd think that the stocks going down would be pushing volatility up, but just like the VIX, just like the VIX futures, and just like my volatility barometer, it actually went down again to 78. And it closed that day at 76. So same thing. It's just one of those things. The volatility is not justified at these levels unless that S&P starts kicking in and doing something a lot more scary than it has been so far. So I'm sorry to everybody who just, every time the VIX spikes up like this, there's a lot of people who don't understand that it's running on fumes at some point. And long volatility is awesome. I use it as well as tail risk for my portfolio, and I'm expecting to do well if there's a recession, an extended recession. But the thing is, it has to happen pretty quickly and pretty violently. Otherwise, it's just guessing. If it happens slowly and it's chopping around, you're just guessing on direction. So you want to get in there, you want to hit that long volatility at the right time, and then it has to materialize. Otherwise, you got to get out. You got to just say, well, it didn't happen this time. Okay, fine. There will be another crash at some point in the future. I am not at all worried that I exited my long vol on Wednesday. Had to. Volatility's not going up. It's fading. So we had to exit that. Okay, missed it. Maybe we'll get it next week. I don't know. I certainly hope not. In this case, it's a war. It's not just a run-of-the-mill crash. I don't want it to get worse. But, it is what it is. You exit. You try to hit that long vol. If you don't get it, there's another crash a few months away. Don't worry. So don't lose too much money trying to justify your hypothesis that just because it feels scary that UVXY is going to pay off. It just might not. And those products anyway have a way of disappointing people. So be careful with them, of course. So that is it for why volatility is coming down. If you want to ask questions about that, go for it. One thing that I should have asked sort of in previous live streams, but I'm going to get in the habit of asking now, anybody who's sort of newish here, you can go ahead and leave your suggestions in the comment section for future topics, and I'll try to get to them. I really want to try to do live streams much more often. It kind of sucks for me. I'm in Taiwan now, and it's 2 a.m, so I got a lot of coffee in me. I'm tired, but trying to push through. But I do want to do these at least once a week, and so if you have an idea for a topic, you want me to explain something, go ahead and leave it in the comments. So let's get to these questions. I'll try to pull her this way so she's not kicking my keyboard. All right. That's better. Little celebrity over there. Okay, question number 1. You know what? I'm going to pause here a second. I think I know what's going on here. There was an update to this software. I'm using Ecamm for anybody who's curious. Because I use a MacBook, Ecamm is a really good software to use. So if you're a live streamer, I strongly suggest it. I am totally inept at anything web design, technology. I don't know how to use any of it. So if I can use Ecamm, then it's a pretty good one. It's pretty user-friendly. But there was an update recently. I just downloaded it today, and apparently it's just going through all these pop-ups. So anyway, bear with me. I'm going to assume you can't see this on your side. It's just a nightmare on mine, but you probably think, well, what's he complaining about? I don't see anything. Yeah. Okay, do you lag your exits to avoid whipsaw, aka wait a day or two to confirm, deny a signal, or are your exits entirely signal-based? We do it immediately on a one-day basis. So I know what you're saying. Sometimes, let's say, because when you're tactically investing, levels have to be chosen, right? There's always going to be a level where you're in or you're out. It's just the way it is. You can move them around. You can try to divide them up. There's always going to be that threshold. So let's say you're going from one threshold to another, and I get the signal today on Friday. Do I move today, or do I wait for Monday or Tuesday? And if it stays in that range for a couple of days, do I do it? My rationale for going immediately is I think a lot of bad things can happen in a day or two. So I always want to be in the correct position at the correct time. And so if I get a signal that puts me from, for example, the real estate ETF today into long volatility, and I get that signal today, I need to act today. I don't want to wait 2 days and make sure that it's still in that range for the next 2 days, because that's not the right trade anymore. Real estate is not the right trade on Monday. It's not the right trade on Tuesday. I understand what you're saying, that you think it might limit the times that you bounce back and forth. Say I buy the long vol on Friday afternoon, Monday the market reverses and I have to get kicked right back out of it. That happens. That's whipsaw. It happens. Tactical investing will always have a line in the sand. You have to draw that line. You go from one signal to another signal. I just feel like, especially when you're dealing with volatility, like we do short vol, we do long vol, when you're dealing with those positions, you don't want to be in the wrong position for more than a day or two. It's just bad things can happen. So I have decided into all my trading, I think you probably saw it just there in that email, but stop doing that. Basically, I get these signals in the morning. I wait about an hour and a half before I gather all my data for the Volatility Dashboard, and I gather more data than this, but this is just what we've shown so far, kind of educating people on what all these metrics mean. But I gather it all about an hour and a half after the market's open, and then the strategies make the decision. And at the end of the day, I take these trades. And the community, the VTS community, takes these trades as well, presumably. I mean, they're following, so I presume that they're trading them. At some point during the day, we take the trades. Intraday doesn't matter. I mean, it's total random walk. I don't know what's going to happen in the next 1 hour, but I just know that on Monday, I want to be in the right position. I don't want to say if this ticks down to utilities, yeah, let's stay in cash for a couple of days. 2 days, you might miss a really good signal. So I just do exactly what is the best position today. I move today, and if I get whipsawed on Monday, so be it. I move out on Monday again, and it is what it is. It happens. It really does. I've done quite a few blog articles. You might want to search my website. There's a search bar on the blog. I've done a few articles there that talk about how often we get whipsawed, how often our strategies, go in and then out the very next day. It's about 25% of the time that happens. You just deal with it. It's just part of the investing process. Okay, do you use VVIX over VIX as a signal, or do you just use VVIX for choosing options? I actually don't use VVIX for hardly anything. It's not in my volatility barometer. I don't think it's a particularly useful metric. Let me try to show you why. The VVIX is very hit and miss. So the VVIX is essentially just measuring the volatility of the VIX index. It's just vol of vol. So the problem with VVIX is that it's really hit and miss. And when you're looking for trade signals, you really don't want something that can be that different. So during some volatility regimes, it will be in the 80s and 90s. And then in certain volatility regimes, it will be very high, right? It'll be 124 or something like that, 150. It can vary substantially. So I think I have it listed here. You can, these are staggered. Why is that? 4 up, 4 up. So the long-term median of the VVIX is 90.27. That's the long-term median, the dead center 50th point. But how long has it been since we've been in the 90s? Look at this. I mean, if you're using this as a trading indicator, you've missed everything going back to, 2019. It hasn't been in the 90s. It hasn't even touched its long-term median in over 3 years. So this is not a very useful indicator. And there have been plenty of periods where you would have wanted to be trading, say, short vol or long equities, but it just wouldn't have flagged for you. The VIX was dropping down 15, 16. The VVIX hasn't even come close to its long-term median. So this is one of those things where you're talking about volatility of volatility, it can be elevated. There can be times when, again, kind of like the S&P 500 and the VIX right now, not justifying how slow the S&P is actually moving, the VVIX can sometimes just for years on end either underprice or overprice that volatility expectation. So you're using a trade signal that it might work really good from 2015 to 2018, and then it lets you down for 4 straight years. It's just not a useful metric. It's kind of like the skew index. This wasn't your question, but skew is kind of the same thing. Sometimes you can look at it and it can just make perfect sense and it can just nail your trade signals. So you go, wow, the skew. I mean, of course, that's when I'm doing my put or call buying or put buying. And then there are other times when it just couldn't be further off. So I tend to use things like TDEX and SDEX. These are the nation's indexes measuring 3 standard deviations. I use those. I do I prefer VIX minus volley. Essentially, the reason for the VIX minus volley is the VIX index measures a strip of all options on the S&P 500, and the volley index measures only at the money options. So if you just take the VIX, which is all strikes, minus the volley, which is only at the money strikes, the residual of those two is the out-of-the-money activity on the S&P 500. So I find this to be a much more reliable trade signal, especially for option structure, than the VVIX. I think the VVIX is sounds cool. A lot of people like to quote it, but I can't have something that's that inconsistent in my models. Is this the time to fade the VIX as we're getting out of backwardation into contango? Nice cat. See, look at her. She's a superstar. I don't know why her feet are pushing me today. Yep, she says hi. She'll keep me company. Yeah, I would say in general, yes. Now, this isn't trade advice, but as you probably know, when the VIX gets elevated, when volatility in general gets elevated, I don't know, 4 out of 5 times, 9 out of 10 times, whatever number you want to pull, a very high number, 80, 90%, it's going to drop down, right? Because it's not justified. The S&P is just not giving it the juice to keep this party going. So, yes, the volatility in the market is going to fade. Having said that, obviously you want to be careful because when the VIX is at 30, it's a very short trip to get to 50, to 60. 80 is a long ways away. It's a significant crisis away, but there's a non-0% chance of a large-scale war breaking out. So, you know, I'm not fear-mongering or anything, but be very careful. Yes, it's a good time to fade the VIX. So what you would want to do, I actually did a live stream on it, and you always want to do defined risk option spreads. You want to make sure that you're doing spreads that have a long and a short contract within them. So the vertical spread has a long and a short, right? So you could do the long put vertical, you could do a short call vertical. Both of them work fine because the Vega right now is extremely high. The VIX is 30, right? The VVIX is through the roof. So you don't want to be buying long volatility and you don't want to be shorting volatility because, you know, war breaks out and you get hammered. So butterflies, iron condors, verticals, these are really good ways to fade the VIX. And now, yes, now would be a pretty good time to start throwing those trades on in an amount that if it goes the wrong way, who cares, right? That's why I like vertical spreads so much when you're trading options because you can structure them to be roughly 50-50. And if the VIX gets to 30, and every time the VIX gets high-ish, doesn't have to be literally 30, but high, like say in its 80 or 90th percentile, if you throw on a vertical, like I said, 4 out of 5 times-ish, it's going to be a successful trade. The one time that it's not, okay, it's a vertical spread. You just lost your premium. No big deal. You don't want to be fading the VIX selling 40 strike call options or something because 4 out of 5 times you're going to win. 1 out of 5 you're going to lose, and it could lose a lot. So you don't want to do that. You want to do the verticals or the butterflies or iron condors. You win 4 out of 5. The one you lose lost less money than the 4 that won. That's kind of what you're looking for. So not trade advice, but yeah, now would be a good time to be looking at fading the VIX for sure. Okay. This is a good one. How long did you wait investing serious money after backtesting your strategy successfully? I like that question. So I started investing in 2005 after I quit golf. I used to be a pro golfer. I retired from golf in 2005, started trading my own money, and that lasted until 2011. Well, I mean, to this day, of course, but in 2011, I started getting, because I was doing it publicly. I was writing articles and had websites, and people were asking, emailing, saying, hey, can I send you a little bit of money, and you can send me the trade signals the day you take them. So VTS is launched, right? That's kind of how it happened. So, but I traded 6 years with just my own capital, and then I launched VTS in 2012 with 3 strategies. I had about 6, but we launched officially with 3, and there was 3 optional strategies. And then over the years, I do introduce new things. I get new ideas as well, and I'm constantly working. So I will come up with an idea. This is basically my structure, how I do it. I'll come up with an idea. Typically, I'll get extremely excited for about 3 or 4 months, and I'll just work 3, 4, 5 hours every single day, just crunching numbers from all angles, and I'll work everything out in 3 to 6 months, and then I'll put live capital towards it. I'll usually put maybe $25,000 into just that strategy and just let it go for a couple of years. And if it works for me, after I've done my due diligence on my own for a good 3 to 6 months of really hard number crunching to make sure I don't miss anything, and then maybe a year and a half to 2 years of live trading, at that point I feel like I can introduce it to the official portfolio. It would be in mine, but that's a much smaller allocation. When I introduce it to the VTS portfolio, that means that it's going to be what I deem safe enough for people to be investing their net worth in. So hopefully that answers it. I would say, 3 to 6 months typically is to get an idea from just, I wonder if that works, to, yes, this is something I'm definitely excited about. And then another 18 months to 24 months of just, let's just set it. Because most of the things I do are systematic. So what I'm really looking for is a couple of different market environments. If it happens quicker, then great. Like if I launched a new strategy in 2019, I would have had 2017 super low vol, Volpocalypse, Q4 2018 crashes, and then 2019. I had 2 very different market regimes, so I can judge very easily whether that's a good strategy. If I came up with something new in February of 2016, I would have had to wait all the way until Volpocalypse to even know how it behaves in a crash. You need to see that with live capital, both a super stable market, a crashing market, a whipsaw market. I'd like to see it all before I actually introduce it to my own portfolio, which, by proxy is the VTS portfolio, VTS community as well. So 2 years, 2.5 years, something like that. Okay, VIX Vol Trader. My first website I ever launched was in 2008. It was the VIX Trader. I lost that website. I didn't renew it because I moved from VIX Trader to then the ironcondor.com, and I didn't renew the VIX. Now I regret it. That's kind of a cool website name. But during March 2020 crash, when did you buy back into the market? April 13th. What signals told you to buy back, as most vol metrics were so high for so long? Yeah, that's the thing. So I kind of made it's an error-ish. I moved to cash in February before the pandemic, even really started. I just felt like, with people so worried, people losing their jobs, people worried about their health, their family, the last thing people want to be worried about is investing. So I kind of made the decision. I've never done it before, and I won't ever again, but I made the decision to move my entire portfolio to cash in February, sort of the tail end of February. And we just stayed in cash until April 13th. And there's nothing specific about that date. It wasn't like I got signals on April 13th and moved back. It was time to start letting the strategies do their job again. So I just sort of set a date a week and a half in advance. I said, that's the date. That Monday, we're going to get in no matter what the market looks like. We're going to get back in. So that's the date that I got back in. As it happened, it worked out pretty well. That was the recovery after the pandemic was pretty violent. So it was a good time to get back in. Now, the reason I say that it was kind of a mistake, believe me, at the time I thought I was doing the right thing, but hindsight is always 20/20, and looking back, because I have strategies that are tail risk specific. I mean, and this isn't even all of them. We've removed our vol strategy. I'm doing a little bit of maintenance on it. So we had an aggressive vol as well. But you can see we do have potential for long volatility positions. We did have 5 strategies during the pandemic. There was another one here that would have also been in long vol. So my portfolio would have actually made 40% just in that month alone. Obviously, it would have been a slam dunk. Like I said, at the time, I thought I did the right thing. So it's not a mistake. Whenever you're trading, decisions have to be made. You can, but maybe shouldn't second guess things that you had such conviction. And it was well thought out. So I can't look back now and say, boy, that was a huge mistake. I lost 40%. Yes, I did. But, I foregone 40%. That's a better way to say it. But yeah, live and learn. My strategies are geared towards doing well in bull markets, of course, but also being fully prepared for bear markets. And yeah, I regret it. I'm not going to say it's a mistake because, like I said, I really thought I was doing the right thing. But regret and mistake are 2 different things. I do regret doing that. So April 13th, nothing specific on that day. But you are right that the volatility metrics do remain sticky for extended periods of time after a crash. And how long they remain sticky is pretty directly proportional to how serious the crash was. So in 2008 financial crisis, when you've got something that's crashing for 6 months and it's terrifying, volatility is going to be sticky. And a lot of my vol strategies in 2009, the lows were March 9th, 2009. Some of my strategies were still in safety positions in May. I mean, that's how long it can sometimes take. The pandemic as well. The strategies, when we did bounce back in, it had cooled off enough that we started to dip a toe in those, but it was a month at least before volatility started calming down. So if it's just a quick, scary moment and then total market resolve, the volatility can just bounce back immediately. But proportional to how scary and long the duration of the crash is, you can see volatility. For me as a conservative investor, it can keep me on the sidelines for a few weeks afterwards. Give the cat a little love. Okay. No, sorry. I hate when I do that. I click it and then I regret it because I see there was one above that. Okay. There's another one that caught my eye that I'm definitely going to go to that one. I know you don't consider partial switches between assets when the indicators dance on the cut lines, but could a partial take profit be an exception for VIXM huge spikes in VB threshold? Again, I know what you're saying, but lines have to be chosen, right? Breakpoints exist, and you need to exit into the right position. So I don't do any half positions, but like you're saying, could there possibly be something that gets you out, maybe profit taking a little bit? There actually is for me. Oh, I think my internet. I hope you guys are still there. There actually is for me. So this isn't something that I can really share because I have my own system of doing this, but there is a step process for me where the initial signal to get into the long volatility, it happens at, 80%. After a certain set of things happen in that 80%, after a few days, I will click that signal up to say, whatever the system tells me it is, but 81, 81 and a half, 3 days later, 4 days later. If volatility continues to spike and we remain in that position for another 2 or 3 days, again, the system is going to be adjusting on those daily data dumps that I input on my spreadsheet, and the threshold might be constantly creeping upwards. So to give you an example of how high it can go, during the pandemic, the volatility barometer, it's geared so it's never going to get to 100 and it's never going to get to 0. I just like it that way. So the highest it ever got was 90.55, I think. But because that signal would have been long, 3 weeks, 4 weeks, it actually ticked up so far that at 87%, we would have exited out into cash and we would have taken that profit. So it does sort of bleed up and chase that market. We've not got that. I think we were only in long vol for 5 or 6 days during this latest crash. And VIX futures barely touched 5% in backwardation. This was the most tame volatility reaction to a somewhat serious incident that we've seen in quite some time. So, again, maybe I should do a live stream next week on that, just showing you, this is, of the last 7 or 8 crashes, this was such a muted volatility response. But yes, long story short, I actually do have profit-taking methods with long volatility. Nothing else. It's not necessary for equities or bonds or real estate. But for long vol, I think you know why you're asking the question, because that whipsaw can be pretty violent, and sometimes you do just want to cash in. So yes. It won't be 80. 80% is the entry, but that's not the exit. It's just hard to show in an email. I might actually change the dial every day that it changes, but yes, we will be profit taking those long vols. So the one that caught my eye was this one. How do you take care of your mental health? I have not given this much thought. It caught my eye because I thought, should I be taking care of my mental health? How do I take care of my mental health? I guess it's just going to sound stupid, but just living a disciplined life. Everything I do is disciplined. Everything I do is, I don't even know how to say this. Like, I do my work at the same times every day. I make sure that I get off time so that I can enjoy some hobbies, golf when my back isn't killing me, hanging out with Vanessa, hanging out with this little girl right here. We play every day. Working out, consistently working out. I think that maintaining fitness is it's super important, and travel and just doing. When I'm working, I'm 100% laser focused on the work, and it helps that I enjoy it so much. So I'm always kind of careful dancing around these subjects because easier for me to say. I'm privileged to get to work 10 hours a day at what I do. I feel lucky that I get 10 hours that I can just sit down and do what I love doing. I was doing this for 7 years for free, and if the community stopped and everything ended, I'd wake up tomorrow, my day would look exactly the same, minus sending an email. That's the only difference. So easy for me to say, but I would say I just maintain a very consistent, disciplined life where every factor of my life, I make sure I'm doing a really good job. And then that allows me to take time off, to travel. Again, it's almost silly for me to talk about because I am in such a fortunate position, but I get to take my work on the road with me, which helps a lot. Like in the last year, I was in Vancouver, I was in Panama, I was in Dubai, I'm in Taiwan. Couple months from now, we're going to Switzerland. So I just take my work with me where I go somewhere. And, anybody who can get your job to be a mobile job, I just could not recommend it more. It just helps so much. Working 10 hours a day is hard, but working 10 hours a day in Switzerland, when you've never been to Switzerland, I'm still going to work 10 hours, but that means that I sleep for 8. I get 6 hours to hang out in Switzerland. I'm not concerned about mental health when that's the case. I get concerned about people's mental health when they go to a job they don't like, and then they have to come home to a home that they don't feel secure in, and then they're in a relationship where there's tension, and then they're unhealthy, so they feel bad, and they kind of just crash on the couch, and then it can kind of snowball from there. That's when you start concerned about mental health. So I would just say you just got to get disciplined in all aspects of life and just make sure that you're progressing forward. I don't want to go all Jordan Peterson on people here, but set small goals for yourself that are attainable and make sure that tomorrow you are a better version than you were today. Not compared to me, not compared to anybody you see on Twitter or Instagram. Who cares about anybody else? You're in competition with yourself, and just make sure that you're a little bit better this week or next week than you were this week. And mental health takes care of itself. But I totally understand that this world is brutal for, a few. You adjust those thresholds just a little bit, and unhappiness can set in pretty quickly. So again, I'm dancing around it because I just feel so fortunate. But yeah, good luck. I feel great. So that's why I said it caught my eye. Like, boy, my mental health, I don't even think about that. Okay. Do you think there will be a massive VIX spike sometime in the next few months? Along the lines of a spike like we saw in March, April of 2020. What do you mean, like a multi-day, multi-week spike? Not really. These are always hard because the answer is, on a long enough time horizon, the odds of that is 100%. There is no chance that this market is going to escape a major financial crisis. Whether that happens in 6 months or 6 years, I don't know. I just know that on a long time horizon, it's 100% certain that we're going to see something that's as scary or more scary than the 35% drawdown during the pandemic. It's just going to get worse than that. There's no doubt about it. If you're limiting me to the next few months, just odds on, no, because I think I even have that VIX chart up still that we can look at. So here's the VIX. Here's the VIX index going back to 1990. I mean, you're saying in the next few months, for my statistical brain, I'm just looking at, this is a 30, or actually this is a 17-year period. In the last 17 years, it's only happened twice. So if you're expecting something that's only happened twice in 17 years to happen in the next 6 months, I'd say the odds of that are low. Now, if you're asking me if I could stretch this chart out, yes, we're going to see another one of these peaks, and it's going to be very, very scary. And it's probably going to last a long time because the Fed is probably out of bullets, out of ideas. What are they going to do the next time around? The only reason we escaped COVID as fast as we did, people forget, but there was trillions of dollars just thrown at the market. So, that's not happening again. So, 100% certain in the next 6 years, low probability in the next 6 months. So don't go out there putting your whole account on VIX calls or anything. It might happen, but if it does, you got to let that go. You can't look back and say, I thought it was going to happen, but I didn't do anything. We all think it's going to happen. Everybody in the chat right now probably thinks there's going to be a major crash at some point. But you should never assume that you're going to catch that and you're going to actually make a bunch of money off it. All you can do is have a system to dip a toe in the water at the right time. Like for me personally, when volatility reaches a certain high level, I can start dipping a toe in the long volatility trades. If it works out, great. If it doesn't, I got to wait for the next crash. So I feel like you didn't, where's my thing? That's annoying. There we go. Looks better. I feel like there's more in this question than you asked. So the words in front of me, my answer is no. I feel like you're leading me to give you permission to do something on the long vol side. So I would say no. It's a low probability trade. Okay, James, I mentioned a Volpocalypse Threshold indicator in one of your videos. How is it calculated? I'm going to hold off on that, and I'll probably eventually just tell everybody in an article and video how it's calculated. But the Volpocalypse Threshold, it's not an issue right now, so there's no reason to just jump on this. But within my Volatility Dashboard, I did hint towards, there's several other metrics that I track outside of these, but one of them is called the Volpocalypse Threshold. And essentially, in a nutshell, without going into the calculations, it's basically tracking how large the VIX futures market is compared to the assets under management in the volatility ETP space. And the reason that this is very important to track is because a lot of the volatility ETPs, vast majority of them, we lost a lot of the midterm ETPs. So they're all kind of hanging out in this front 2-month VIX futures. When you've got a situation in 2017 when it was such a crowded trade that the VIX futures market was just totally overwhelmed with the aftermarket rebalancing, you have to know that when the volatility ETP space, TVIX, XIV, SVXY, UVXY, VXX, VIXY, all of these, when they're all doing the rebalancing and there's $5 billion in AUM, it's going to overwhelm the VIX futures, and they just don't have the liquidity. So when there's a crash, what happens? Volpocalypse. That's what happened. There was no manipulation. There was nothing really nefarious happened that day other than $5 billion of capital is trying to go through a market that's smaller than the derivative market it is based on. So I have this metric called the volatility or the Volpocalypse Threshold, where I'm basically tracking how risky this is. And right now it's a non-issue because the volatility ETP market was basically decimated after Volpocalypse, and some of the volume has come back, but it's not nearly at alarming levels. So right now the balance between VIX futures and volatility ETP assets under management, very manageable. Knock wood, anything can happen, but I'm not expecting, even if there is a major crash in the market, I'm not expecting that market to break like it did the last time, because my threshold shows that the VIX futures market should be able to handle the volume right now. 2017, it just couldn't. And I was messaging for months. I made a lot of videos and I wrote articles. I was telling people, look, this thing can break in a day. And I was called crazy for months. For like 6 months, people are making fun of me. Oh, you don't know how they work, Okay. I didn't call it or anything, but I said, like, this is going to happen at some point. It's one of those, like, getting back to this question. If you're going to say in the next 6 months, no, it's a terrible bet. If you're going to say eventually on a long time horizon, absolutely XIV was going to break. There was no doubt about it. So, I didn't know that it would break 4 months after I wrote an article on it, but I knew it was going to break. Right now, it's not risky, so don't have to worry about that metric. Good question, though. I'll eventually circle around and throw it up there in the dashboard. Feel like, as you probably know, I get an insane amount of emails every day, and a lot of the things I'm doing this year, I have decided to try to actively reduce the number of emails I get. And so introducing a metric that would be asking a lot of follow-up questions that is totally irrelevant to what we do might not be a very good time to introduce it because, like I said, it's a non-issue right now. Plus, a lot of the volatility ETPs are started to use swaps now, so they're not all M1, M2 VIX futures. The new one, if it ever does launch, the SVIX, the UVIX, they're going to expand that rebalancing window. There's a lot of things that can be done, so I might never have to introduce that metric again. I think the VIX futures will be able to hold up a lot better than February 5th, 2018. Okay, interesting. Since the short vol trade has become less interesting the last few years, has long vol become more viable? So I'm not one of those people that ever thought that there's this, huge difference between the short vol trade and the long vol trade. The options market itself and the volatility market itself has been efficient for quite some time. So certainly in the 90s, there was arbitrage on the short vol side of things. It was kind of fairly easy, to be honest. You just kind of sell the premium and it was paying. You look at the Iron Condor index, for example. You look at these buy right indexes. They were doing very well in the 90s, the 2000s. Right around 2005, markets became quite efficient. So there was there's no difference between, short vol, that's the smart trade, and long vol, that's the dumb trade. Options trading, volatility trading is always, are you paying too much or are you paying too little? That's really what it's about. There is no, you should only ever short vol because only dumb people buy long vol. The only thing is the win-loss ratio, of course, will be different. If you're on the short vol side of things, you might win 90% of the time. The times that you lose will be big losses. If you're on the long vol side, you might lose 80 or 90% of the time, but you might get outsized wins when you get them. But overall, it is a very efficient market, and it has been for 15 years now. So there's nothing inherently wrong with being a net long volatility trader. Just don't pay too much for the volatility, and then you're good to go. That's what alpha means. It's just buying things that are cheap, selling things that are expensive, and there's no cut and dry rules like that. Those are just things that sell on Twitter. It sounds good. People will make fun of all the people that buy long vol, and they'll say, well, I'm just, I'm an ATM machine selling short vol. Sure, but you're not counting all those times you blew up in the past. Like, I follow some of those people that do that think that they're inherently better traders because they short vol only and they make fun of all the long vol guys. I've watched them literally blow up their accounts shorting vol, and they're still talking about pointing fingers at the long vol people. It's not, there's nothing wrong with long vol. There never was. So I totally agree with where you're going with this. Yes, people should start taking more seriously the long vol trade. It's tough. Of course, timing is hard, and keeping your profit after you make it is hard. It's hard to know when to pull the plug and take the profit off the table. But there's nothing inherently wrong with it. Just underpay for your option premiums, and you should be fine long term. Is it more interesting now? No, I think it's the same market. It's just I think people will be more willing to do it now. In 2017, you sound like you need to go in a padded room if you're talking about buying long volatility, right? Nowadays, with so many crashes in the last 3 years, yeah, it's starting to make more sense. But it always made sense. Ask anybody who actually trades volatility for a living, who actually, not Twitter people, not people who pretend to be something they're not online. Talk about people who have real clients, who have real books, who have understanding of volatility trading. A lot of them are on the long vol side, and there's nothing wrong with that. If you know what you're doing and you're not overpaying and you're looking for cheap deals, essentially, nothing wrong with the long vol trade. We have our VTS options portfolio sort of on hold now. It'll come back soon, a few months. But several of my option strategies are long vol based. Nothing wrong with long vol. I've made lots of money trading long vol. In fact, probably the same amount. Honestly, if you just factor it long term, I've probably made just as much long vol as short vol. It's just about finding the right times to short when you're selling premium that's too high and when you're buying premium that's too low. Rinse, repeat over hundreds and thousands of occurrences. Law of large numbers. You will make money long term. That's options trading in a nutshell. It is no more, how do they say it? It's simple but not easy. It doesn't get any simpler than that. No, easier said than done. Okay, if you close on UVXY, do you wait until after that? So if you close on UVXY, would you wait till after Fed to sell? I don't trade based on my market predictions. My options trading, I allow myself to have some discretion, but for my main tactical strategies, this decision is not mine to make. I don't say, okay, I'm going to wait until Thursday because I'm scared about the Fed. I'm just going to look at volatility on Monday morning. I'm going to input all my data, and I'm going to take the trades that my strategies that have been successful for 10 years are telling me to do. Doesn't mean on Tuesday I'm going to make money, but it means that if I do that every single day over multiple years, I'm definitely going to be profitable. So I don't know what I'm going to be in on Monday because it's not Monday. It's Friday right now. So I'm going to wait till Monday and go for it. I'll try to not punt on this question. If you are a person who trades based on your personal market predictions and you are discretionary, not investment advice, I don't think that's a bad idea. I think there's a lot of uncertainty in the next 3 days, over the weekend and then in the next 3 days. How old are you? I mean, you're probably, let's say you're anywhere from 20 years old to 60 years old. YouTube analytics say that my audience is basically 25 to 55. That's where, 90% of my audience is. So don't be too concerned about how much money you make in the next 3 days. Try to understand that you've got 30 years to do this. You don't have to swing at every pitch. That reminds me. I sent out a tweet on February 2nd, 2018, the day before Volpocalypse. I sent out a tweet saying basically what I was talking about today. Most of the time, volatility fades when we hit these levels. And remember, volatility on February 2nd, on the Friday, it dipped into backwardation 4%, 4.16, I believe. So, I mean, the signs were clear as day. You should not be short vol heading into that Monday. I actually sent out a tweet Friday saying, look, the chances are decent that it fades, but remember that all terrible things have to start with that first dip into backwardation. And I literally said the words, you don't have to swing at every pitch. Be careful here. And then we all know what happened on Monday. So I don't know why that jogged my memory of that. But if you are the type of person that uses discretion, try to understand that you don't have to jump in the next 3 days. There's so much uncertainty. Unless you have a systematic reason to do it, I don't know. Do you need to play this one? It could happen. The variety of outcomes in the next 4 days is so big, we're all guessing. There's nobody, I mean, there's going to be people on Thursday who are going to say on Twitter, they called it. They didn't call it. Nobody knows what's going to happen in the next 3 days. Nobody knows what's going to happen over the weekend. Futures spiked like 1.5% in a minute today. And last time I looked, the market was back to red. Nobody knows what's going on. The market's down 0.1%. So Fed meeting next week, God, there's going to be a whole bunch of people pretending they knew something ahead of time. They certainly don't. So you don't need to do this. If you're asking me on a live stream, I think there's your answer. Nothing wrong with sitting on your hands, doing nothing. Cash is an active portfolio position. Remember that. Nothing wrong with cash. Okay, interesting. I think I kind of answered this. If markets keep going down and more people go short vol, is there a possibility of a short vol squeeze similar to the 2018 Volmageddon? Sorry if you've answered it, just tuned in. Well, thanks, Cool Dude 420, for tuning in. Appreciate it. Subscribe, like, do all that stuff. No. I'm going to say no for the same reason I just went over, that right now the VIX futures market is plenty liquid to handle whatever spikes are coming. So the Volpocalypse threshold that I track, it's in a comfortable range. We're not, if you're talking about an intraday move that's actually justifiable, like the VX30 and the VIX futures spikes up massively, that could happen. We are, like I said before, I don't want to doomsday here, but there is a non-0% chance of a world war. So let's not take everything off the table. A single day VIX spike of 100% is possible. But if you mean an aftermarket rebalancing squeeze like that happened on February 5th, no, that's probably not going to happen. The volatility ETPs are a shadow of their former selves, just a shell of their former selves. So, no, you don't have to worry about that as much as you used to be able to. I keep track. If the vol space gets that big again and it starts to get to that alarming levels where it seems like the VIX futures might have might struggle handling that volume, yeah, I'll let everybody know. Absolutely, I'll do videos, I'll do live streams, I'll spell it out. Look, you might want to deleverage, or you might want to just carry some throwaway out of the money options. I will definitely spell it out so everybody is fully prepared for when that happens. Right now, I think you never want to say anything definitively, but I think it's very, very safe. As far as the squeeze, as far as the one-day actual justified move, wow, I mean, sky's the limit on how bad vol can get here if this situation gets worse. Like I said at the beginning of the stream, I don't know about you, but every morning I shouldn't do this. It's a bad habit, but my phone's next to me in the bedroom, and I just grab, as soon as my eyes open, I grab the phone, I check my Bloomberg, I check the futures, And every morning I'm expecting it to be limit down. And so far it has not been. So good. That's good news. Because like I said, in this case, if it's limit down because the government is arguing about a debt limit, I mean, blow it up. I love long vol. I love making my long vol profits. Tail risk makes me so happy to profit when everybody else is losing money. But if it's on a serious thing like a pandemic or a war and people are dying, I mean, it's awful. So I don't want to see that. Even if I'm long vol, I'm kind of hoping that I just get whipsawed and lose the money, to be honest, because I don't want to make 50% on a war. I want to make 50% because the government is completely inept at their job. That would make me happy. I don't want to make money because people are getting hurt. So, but yeah, it hasn't happened yet. Market's been muted. Again, getting back to the very beginning, the S&P 500 always has the burden of proof to the volatility space to prove that these high levels are justified. And every day I wake up, I just think, nope, that's not it. That's not going to do it. That's not going to keep the VIX at 30 for very long. That's not going to keep the UVXY elevated. It's gonna bleed down. It has to. That's what we're seeing. I love Jordan Peterson. He changed my life. I was slow to come around on Jordan Peterson, but I'm really starting to like where he's going recently. A lot of the things he says are starting to resonate with me. He's one of those really polarizing figures where initially for months I would listen to him and I don't understand what people are, it's just word salad. Like he's just piecing together words. It doesn't mean anything. There's no point to any of this. And then it seems in the last year he's really narrowed down a little bit, and it's a little bit less of the just all over the place thoughts and then this tangent and and now he's, I'm starting to really like him. So I don't own a TV. I don't watch much, but on YouTube I occasionally watch those motivational things and I'm starting to like him. Yeah. You're pushing me. You're trying to make me justify what I know you're trying to do. You want to go long vol. You think the market's going to collapse. You think the world is in trouble, and you're going to make a fortune with this long vol trade that you've got cooking up in your brain. And you're asking me to give you the green light to go for it. I'm not going to do it. The odds of a long extended recession that's ugly like financial crisis-ish is, in my mind, near 100% on a 10-year time frame. If you're going to limit me even to a year, I'm just not going to say that the odds are good. It just doesn't favor it. There's only been 2 of them in 17 years. What would make us think that we're going to get another one right now? We always think the time that we are living in is the big one. We always think that. People in the 80s thought Volpocalypse was right around the corner. People in the 90s, the 2000s, everybody thinks that their generation, what they're living in, their stock market that we're trading, no, this is the hardest market it's ever been. That's what we think because we're trading it. It's ours. There's no way. Our parents, they had it so easy, right? That's what we all think. Could you imagine if my parents had to invest through the Volpocalypse? They had Volpocalypses of their own. They had interest rates at 20%. They had coming off the gold standard. Can you imagine what that would have felt like when you were in it? Imagine what the dot-com bust would have felt like. I wasn't trading back then. I was golfing. We always think that this is it. I can't believe my generation's going to witness the end. No, it's not. The market is going to do what it does on balance of probabilities, the same as it has done in the past. So, no, you can't just give me an extra 6 months and have me say, okay, yeah, you're safe. It's going to crash for sure. The odds are low. I don't know what to tell you. The odds are low. But tune into my live streams, watch my videos. I do go long vol about 5% of the time. I just do it tactically. I just do it when there's a justifiable reason. I don't do it because I think, okay, I'm going to put this on and then 6 months from now, let's hope that it crashes. I put it on the day that it's the right trade, that day. And if it's no longer the right trade the next day, then I take the trade off the next day. Like I was long vol from last week, I think, Wednesday. right up until Wednesday of this week. And then on Wednesday, it was no longer the right trade. Volatility's going the wrong way. The S&P is not moving enough to justify being long vol right now. It's just not. It's moving less than 1% a day. VIX isn't going to stay at 30 if that's all that's going to happen. So it was time to take that trade off. I don't do the whole long call 8 months out and cross my fingers. I am tactical to the day. And maybe on Monday something bad happens, volatility elevates, it pushes me up into that 80% range, and maybe I jump in the long vol trade on Monday. Totally could happen. But I'll have to wait for Monday to see if that happens. Okay. I don't hedge my portfolio, so I am of no help to you. Hedging is a mathematically bad bet in my mind. They are throwaway trades. So I believe in strategy diversification and making sure that as of today, 14 strategies that I trade, 4 tactical within VTS and 10 strategies within VTS options. So I have 14 different strategies trading every single day right now. There was 15 like a month ago. We removed one, so there's 14 now. I believe that if I am doing my job, all 14 of these strategies are going to be reinforcing the hedge already on their own. I'm going to have strategies that are losing money. I'm going to have some that are making money. And I am calculating the allocations to put towards each one of them. So I don't actually require any hedging. So I'm not a good person to ask about hedging. I'm not a buy and hold investor, and I just don't do that. What about hedging UVXY and SVIX? Well, SVIX hasn't launched. I'm just going to make absolutely sure. I haven't seen any. No, it hasn't launched yet. I did an article on it literally in 2019. It's been 2 years now. Yeah, it hasn't launched. So I don't know. Maybe you mean SVXY, but again, I don't hedge. Jordan Peterson has gotten less academic the last years and actually being involved in current issues. Could be it. Could be part of it. I've just started to resonate a little bit more with his message in the last couple of years. I think he's helping a lot of people. I think many messages, but the one that I've been saying the same thing for years. I'm just not Jordan Peterson, so nobody heard me, but maybe someday I'll do some type of thing as well. But I agree with him 100% on any time he's talking about personal responsibility, setting goals for yourself, understanding that everybody out there, no matter where you are today, you can definitely get yourself out of what you feel bogged down with. You set small goals, give yourself some responsibility, and start attacking those goals. Don't compare to other people. What is that old saying? Comparison is I don't know. I can't remember. Don't compare to other people. I should be able to think about that. Why did my mind just blank out? Anyway. You'll get very unhappy if you're comparing to other people. But yeah, I like his message about giving, and young men, right? Because he talks to young men. My YouTube audience, I don't know why it is, but my YouTube analytics show me that 98.5% of my audience are men. So when I say, guys, and I literally can say that because I for whatever reason, women just don't follow my channel. So, oh well. I have not said anything negative towards women. I like all women, and they're welcome to join, but yeah, it's men. But Jordan Peterson does give young men in this world, hope and motivation, and not based on easy way out, not based on any handouts, not based on, victim mentality, based on you can do it. But it's you. It has to be you. Nobody's going to help. Nobody's going to save you. Nobody's going to give you anything. Nobody's going to help you. Even the people you think are your friends and family, they might not be able to help you. So, I'm in trouble. Dude, you never answer my questions. Well, I'm going to make it a point to go through all of the questions So in my defense, apologies, in my defense, the software that I use tends to not show questions. And then sometimes when I scroll up, like I'm seeing a couple more that I didn't answer. That's not you. I didn't see that before. Yeah, there's several. So let's see if something from you popped up. This is you. This is new. VIX Central looks like a whip. Yeah. This is new. Sorry about this. Sam, SPX applied move from close. Open to close for the last week. Implied move. You're talking about, I mean, is it close to close? No, because it's just based on options activity. So the VIX, I mean, right now the VIX is whatever it is based on the current pricing of those options. So it's not like there's no cutoff where they calculate the VIX print just once per day. The VIX is a rolling indicator. There might be a little bit of a delay or something, but okay, so the VIX didn't hit the pre-high. It means a lower low may strike as the bottom. Do I agree? So that was your question that I didn't answer? The VIX didn't hit the pre-high. It means a lower low. Does it? Or is that just what happened? I'm not sure if that's true. I think I know what you're saying. Like some people are looking for that as a signal. So if the VIX hits 32 and the S&P is whatever it's at, and then a couple hours later the VIX has a lower low, or maybe the VIX pushes higher but the S&P didn't push to that level. So people are looking for those exhaustion signals basically. I don't tend to do my exhaustion signals on price itself. I tend to do it more on momentum, the changing ratios. I do track them, but I don't do it quite like this. So do I agree? I don't know. Because maybe something terrible happens in the next 20 minutes and it blows right through it. All you're really doing is reporting the news. You're just saying that here's what didn't happen, here's what it means. It could have happened, and it might happen an hour from now. It might happen on Monday. We don't know until after the fact. But I would be careful to always look for, it sounds like confirmation bias to me. Let's see if you asked anything. I'm going to get to this. You said I never answer. I'm going to answer everything you said. Most of the time, you should short premium when VVIX is high and be careful when VVIX is low. Again, I would not agree with that because what is high, what is low? So here's the VVIX. Okay, so you're saying that you should be careful when it's low. So from 2012 to 2017, 5 years straight, you're going to be careful? And then from 2018 to 2022, you're going to be short? I mean, this is what I'm saying is it's just such an unreliable metric that it can spend years doing something counter trend. I just don't see it as useful. It just doesn't pan out the way that people think that it should. The median is 90. It hasn't touched that in ages. And then it can be it can be in the 70s and 80s forever. And there's VIX spiking up and down during that period. There's good short vol entries. There's bad short vol entries all along the way. And the VVIX is still giving you those mixed signals. So I wouldn't, I'd give up on it. Honestly, if you want to use it for pure option pricing, like you have actually decided on the trade you're going to take, and all you're really looking for is just a little indication on maybe if premiums are elevated or whatnot. If you're looking for, should I take my trade on the UVXY? Should I take it on VIX options? Should I buy SPX put options? If you're talking about that, then sure, the VVIX might give you that final little indication that, hey, if it's super high elevated, yeah, maybe you can go for the, buy your, whatever you do in the VIX options market, or if you're selling them, sell that higher premium in the VIX options market. Maybe avoid the SPX put options or whatever it is. But in general, no, as a broad signal, I would stay away from it. VVIX normally has a mean reversal property. You can take the measurement for the mean median mode to track it. How do you agree that don't? I don't agree with that either. It does not. It's not on a short-term basis. I mean, sure, it has a median of 90. I showed you that. It has a median of 90. It's been above it for 3 years straight. That doesn't seem like mean reversion is terribly strong in this thing. So technically anything in the volatility market will be mean reverting at some point. But I think this is getting into that mean reversion versus mode reversion. If you're talking about a mode reverting index, the VIX is far more mode reverting than the VVIX, it does seem, doesn't it? I wouldn't agree. I'm not hacking on. If you found a way to use the VVIX better than me, then go for it. I'm just saying that I'm not seeing it. Explain people don't chase debit plays when VVIX is so high. They don't? There's been plenty of good entries when the VVIX is 135 or higher. There's been plenty of bad entries when it's 80 or lower. I guess I'm just saying the same thing over and over here. I think it's a really bad indicator. Okay, my page stopped going, so I'm just going to clean a few of these up, and then I'm going to go to bed. It's actually 3 in the morning for me, so this one right here wants to go to sleep for good. There's a mosquito. Come on. Thinking if, oh, wait, why same bearish direction? I mean, if thinking the market will drop, why not long volatility or just short ES SPY? Yeah. I don't know for sure because it's comments, but sometimes you try to read things into the comments, and it does seem like there's a few people in the chat right now that are trying to justify reasons for going long vol. They really want that. They want it so bad. But sometimes you just can't. It's just not the right time for it. It's not lining up for that. What is this? Mandatory UFC. Have you seen Bryce Mitchell fight? Yeah, I think Bryce Mitchell is... Whoa. Hey. You lay back down. That was not nice. She's actually... she's a funny cat. She'll lash out at you for like half a second, and then it's over. She's done. She's got the temperament. Like, she'll get angry for 1 second, and then that's it. Bryce Mitchell's awesome. I would not be surprised at all if he's title contention ready in 2 to 3 fights. I mean, I think Edson Barboza's a little bit washed, to be honest, and I say that not because I don't like him. I think he's fought just a ridiculously hard schedule. If you look at guys like Edson Barboza, RDA, their schedule, the guys that they've fought are crazy, but Barboza's a little washed. So let's slow down a little bit. Mitchell completely dominated him, but I think just looking at the skill set, yeah, I think I think he's a problem for sure. I think we need to slow down a little bit on the comparisons to Khabib, though. A lot of people are saying, oh, does he have as good ground control as Khabib? No. Khabib lost like 2 rounds in the UFC. Who the hell will short VIX directly? Well, you can't short VIX directly. It's a cash-settled index, so you can't hold the VIX in any capacity. But if you mean VIX options, guilty. I trade VIX options all the time. Love trading VIX options. One of the great things about literal VIX options market is it's so misunderstood and so complicated with so many moving parts. It's a derivative of derivative of derivative. Anytime there's something that's really hard, there's opportunity there. So if it was easy to understand and if it was easy to make money there, there would be no opportunity there. But because it is so difficult to understand what is going on, the VIX options are there and you can trade it, but you can't trade it. And it doesn't track the VIX index, it tracks the VIX futures. And it's actually a pretty confusing thing, but it's worth the effort to push through all that and try to understand what's going on there. I would say, and I actually have a video that I've been putting it off for ages, but my most profitable strategy is since 2007, and it's just been going for 14 years profitable, is my VIX options strategy. And it's far too complicated to introduce to a community. It's way too many trades. I mean, oftentimes 20 to 30 per month. Intraday trading, oftentimes, like if I get a signal, I have to log in and do it. It's just not conducive to a community. But trust me, the VIX options market, for those who are going to put in the work, it's there. I love hard things. I don't know if you've been following me for a while, but I design my life around doing the most difficult things. I think that that's where all the opportunities lie. So I was a professional golfer. You know, obviously the odds of making it are slim to none. I didn't care. I just pushed through and went for it. There's opportunity there. And if I would have made it, I was close. If I would have made it, big payoff. Trading's the same. Don't go for the low-hanging fruit. Don't go for the things that other people easily understand. Go for the things that are so complicated, people turn it off as soon as you start talking. That's where you want to focus your efforts. And the VIX options market, me. You're competing against me. If you trade VIX options, you're not competing against your average Twitter guy. You're competing against people who probably at that point know what they're doing. When you get down to, first of all, options trading in general, you're going to eliminate a lot of the market participants. Then you're going to get into volatility-specific option trading. Now you're going to eliminate even more. And then you're going to get into the VIX index options, which are far more complicated than even the VIX futures and the VXX, UVXY. You're getting down to a very narrow range there, and you know the volume speaks to that. There's just not that many people understanding what's going on in that market. So don't write it off. There's profit to be made on doing difficult things, and it's very, very difficult to get any edge at all on all the low-hanging fruit. And that applies to everything in life, whether you're talking about trading, whether you're talking about fitness. If you want to do the fitness level of the average person, you're going to have the fitness level of the average person. If you want to be very fit, you have to do hard things, right? Trading's the same. Come on, stop that. That's not very polite. Okay. I think that's it. So, yeah. Thank you, everybody. How long did we go for? Oh, no. Every time I say I'm going to do an hour, and we go way long. So if you want, I always scan at the end of the live stream. So if you want to leave comments, if you want to leave questions, if you want to give me suggestions for future live streams, go ahead and do that. Drop those in the comment section. I will see it after I turn this off. And yeah, look at this little girl. All right. That's it, everybody. So live stream next week for sure. Hold me to it as well. If I skip a few days, make sure you let me know that we should do another one. I'm going to start doing these regularly. So, all right. Good night, everybody. It's 3:15 in the morning for me.